Hello, everyone, and thank you for joining another episode of Beyond Wall Street podcast. We have another very special guest. Before we introduce our guest, we do want to give our legal disclaimer. Beyond Wall Street podcast is for educational and informational purposes only. Nothing discussed in this episode constitutes investment advice, a solicitation, or recommendation to buy or sell any security or investment product. Alternative investments involve significant risk, include the potential loss of principal, and are typically available only to accredited investors. Past performances, Past performance is not indicative of future results. Always consult a qualified financial advisor, attorney, or tax professional before making any investment decision. The views expressed by our guests are their own and do not represent the views of Beyond Wall Street podcast or its host. All right. And one more introduction before we get into our conversation. We do want to also give a shout out to our sponsor, America's Smart Homes and Businesses. America's Smart Homes and Businesses is serving homeowners, multifamilies with air conditioning solutions and generator solutions. They find the problem before they feel the problem using their technology with advanced artificial intelligence and analytics and alerting homeowners about any air conditioning issues and repairing and fixing those issues as quick as possible. All right, we have our guest here. We have Amanda Cox, President and COO from Bel Aire Multifamily Management. Did I say that right, Amanda?
Yes, right on, Gary. That was perfect.
Awesome. Well, just so our listeners get to know you a little bit, could you talk about your background and what led you up to where you are today?
Yes, absolutely. So I like to say this industry chose me. I did not choose it. I think that is how a lot of us get into the multifamily space. I started leasing apartments when I was in college at Texas State University. This is my 18th year in the business, and my goal was to get my $400 a month rent paid for. And so I leased units. And when I graduated from college, my options were go home and be in oil and gas with your parents, which was in Houston, and I did not want to do that, or stay and manage multifamily. So I worked directly for the owner of the property that I was leasing at in college as a property manager and just continued my career from there. I've worked directly for owners. I've worked with some large management companies, which gave me the confidence and the roadmap to become an entrepreneur. And about 4 years ago, my business partner, George Lentz, and I started Bel Aire Multifamily Management. And we are located here in Texas. I'm personally in Austin. Our portfolio spans between San Antonio up to Dallas. It's about 4,000 units under management currently and a little over 100 associates at the company.
Fantastic. And just so I'm following everything correctly, you're an owner and property manager, is that right? Or did I misunderstand?
Yes, that's correct.
Awesome. Okay, great. Great. So wow, 4,000 doors. So y'all have really, built a nice foundation there. Are y'all still looking to grow, or are y'all kind of at your point where you're maintaining?
We are absolutely looking to grow. I have aggressive goals for our organization to bring on about 1,000 units a quarter. I want to be at 10,000 units by the end of next year. And we have been working mostly through referrals, our broker network, our previous clients, myself and my executive team have worked with when we were at larger organizations. And then over the last about 12 to 18 months, Gary, our growth has been mostly lenders and receivers working through distressed multifamily. So we're talking physically distressed, economically distressed properties that candidly are not the biggest competition in the management space because they do take a unique skill set, and they're really difficult to manage through when you lack capital. And your teams can really get stressed and overwhelmed in this type of environment. So it has definitely been an opportunity for us to bring on more units, but we know that those are not long-term holds. Our lender partners and receivers are looking to exit these deals, and our goal is that we be able to maintain the management agreement with a new owner, properly capitalize the deal, and then this is the next value add cycle for the real estate space. So I feel like I'm just getting started. I'm in my late 30s, and I'd love to see where we can take Bel Aire. So yeah, hopefully 10,000 units next year, but we'll see where we go from there.
Oh, just 10,000. That's it. Just 10,000. That's so cool. There's a lot of people that dream about getting into this space, and you've reached an order of magnitude, but your goals are still much higher, which I think it's a great lesson for our listeners, whether they're, an investor or operator, just as far as your philosophy and the way you look at things. I think that's great. Now you mentioned Class B. Did you say Class C as well?
Most of our properties are C class. We have a couple value add deals that are underway right now with extensive renovations. And then we have two new lease ups that we're working directly with the developers on. So that's, maybe 20% of our portfolio. 80% of it is going to be in the distress space, B and C class deals.
That seems like such a challenge with Class C properties, um, because you have the economic situation. Sometimes you have, other situations as well within the complex. What's that, if you don't mind, getting into that a little bit, as far as how do you make that transition? How do you make that shift? Because I imagine you're getting it from Class C to Class B, right?
That's the goal, yes, and get these deals restabilized, which candidly, some of them could be 20% occupied, 40% occupied, economically, maybe 20% occupied of that. So it definitely is a challenge. If you haven't been in the industry through a down cycle like this, which a lot of us in the multifamily space have been very fortunate that it's been raising rents, not as much focus on expense control. If you don't pay, you don't stay. Texas is very landlord friendly. And this has been a really challenging season over the last couple of years, especially for operators that don't know how to tighten the belt, that get discouraged by these situations. We have, especially in our San Antonio portfolio, we've had mass deportations. ICE has been on our properties. We have people self-deporting. This could take 20-30% of your occupancy overnight. And it's been devastating to see, especially for our third party clients that don't have the capital, didn't have a business plan strategizing for this downturn, coupling that with bridge rate debt. They had loans that have just completely killed the cash flow. We can't cover all the debt service. So I will say this has been the most challenging market that I've ever worked in. But I think what sets us apart and what I believe is big culturally for success is transparency and being honest with our vendor partners about when bills are going to be paid. We're not calling a vendor partner if you don't have the cash flow to cover the bill. You're really thinking about your reputation and how you're communicating with everyone on your team, because we're all here to have a success story, but that's going to look different per property. And it's not the same environment as when rents are coming in, people are paying, higher on renewals, or new leases where we're extending beyond current lease rates. This is negative rent growth, high concessions, lots of delinquency. So I just believe that what is most critical is that we're talking frequently. At Bel Aire, we call this time period, we're honoring the suck. This is hard right now, but we want to take it head on and be transparent and make sure that our reputation supersedes the circumstances of the cycle that we're in.
Wow. And I imagine, so with the cash flow issue, that makes sense. And I imagine there's other opportunities that start opening up as well, right? Where you get the asset undervalued.
Yes, and this is a big basis correction right now, a great opportunity to come in with new capital into some of these properties that are 30-40% below what they would have traded for. Top of the market was 2022. We're not going to be back there for a long time. I don't know that that money will ever be that cheap again, but there are opportunities where if you're keeping your finger on the pulse and underwriting what's coming back online. I'm seeing deals that I underwrote in 18 and 20 and 22, and just watching these trends. This is opportunity. As much as the distress hurts the current owners in these assets that overpaid or don't have a good debt structure, it is the time to jump into multifamily if you find a good basis correction, because that's where you really make your profit. Is you want to buy at the best time and seasonally exit at a time where you're not pressured to sell, or in some of my circumstances with my clients going through foreclosures.
So it sounds like the two biggest risk in these down times when it comes to multifamily would be overpaying for an asset. So I guess during the good times and everybody's excited about it, excited about multifamily, they end up paying more because everybody's in the market. And then also with that, you overpay, so you take on too much debt, which impacts your cash flow. And then when people leave or whatever, unforeseen circumstances happen, your cash flow is impacted, and you can no longer cover that debt. Is that the big
Yes.
elephant in the room?
Yes, absolutely.
Okay, very good. And so, what are your thoughts on? Because you hear people talk about equity investors versus debt. Um, what are your thoughts on, are there multifamily owners that just raise all the capital from investors and don't take on any debt and it's all equity? Is that a thing, or is that?
No, not really. I mean, if it's a smaller deal, maybe sub 5 million or so, you might have a group of friends and family, or like a 506B offering where you're raising that capital internally. Debt has been historically pretty cheap. So we've seen high leverage on these properties of, 75% LTV. We're not seeing that in this space now. There is more pressure for there to be a higher equity raise, more reserves in the account. Cap rates have also shifted significantly. So there's a lot of changes that have happened in the market. I don't see as many of the investors that were here 4 or 5 years ago investing in the market now. I think a lot of them have their investments are tied up in properties, or they're sending in cash calls into those deals instead of deploying new capital. But typically, you have, in our experience, we work with friends and family offices, institutional clients that are bringing in the heaviest check of the equity raise. And then we have some smaller investors. But it really depends on the strategy of, who your network is and how you've written out your organizational chart as you pursue a multifamily asset.
Got it. Got it. Wow, this is a short podcast. It's 20 minutes long, but I feel like you are covering so much information in such a short period of time. You're really doing great, and I think it's providing so much value to our listeners with your knowledge and expertise. So I appreciate you sharing that.
Sure.
Um, Next question. So obviously you have experience in the space. You're doing some big things. What are some of the challenges that you face on a day-to-day basis? Now, obviously the economics has its impact. Is it mainly like deal flow? Is it additional investors? Is it access to debt with better terms? What all the above? What's on your radar?
All of the above. I will say my main role in Bel Aire multifamily right now is growing the business. So I am out looking for opportunities of underperforming assets, just distressed clients looking for another avenue, some new energy into their properties where their manager right now might feel a little bit defeated. And so that is probably 80% of my time. I'm working on the business development side. I would say on the management piece in general, there's so many people exiting the industry. It's changed significantly since COVID. Expectations are higher than ever from our clients, investors, from residents and their experience. And turnover is probably one of the hardest challenges of our industry. And so we really do a lot to invest in our team members. That's where, kind of tying back earlier into our conversation about communication and frequent conversations, I'm on calls with my whole company saying, this is where we're headed. This is what's going on. Let's talk about the market. Let's talk about what we're experiencing and how can we support you to continue to succeed in your role. I think that connection and being a smaller organization, it's near and dear to my heart. That I want to have that personal touch and to feel like my team understands their role in the success of our organization. I don't know that that is an experience you have in bigger organizations. That's candidly why I left working with large companies, because I just felt like a number. I knew my contribution wasn't making the same impact as what it could in a smaller company. So I think as an industry, we really have to love on our associates, give resources, talk about the hard things, really celebrate the successes too. But just be, we're people managing people. And if our associates are happy, they're going to give a better experience for our residents. Our clients are going to make better returns on their properties. So, this is a moment in time where we all feel in the pressure cooker. It is hard, but this too will pass. We will get into a better market and look back at this and say, whew, I mean, we survived, but barely. So, I think that's not unique to my company. I think that's just what we're experiencing as an industry, and the challenge of finding good talent and retaining good people.
Awesome. And around the challenges, and not just normal challenges. These are challenges at a high level from a high level operator and investor and owner. Um, so very good. Curious. So when we're talking about cash flow and we're talking about management, um, obviously there's certain scenarios. We talked about ICE earlier and that sort of thing, how that impacts things. Are there certain economic indicators that you guys track to say, okay, we're about to be entering a difficult period? Is it unemployment rates? Or is it just kind of you get a feel based on feedback from your tenants?
It's both. We do follow analytics of migration of people into the city, what job growth opportunities look like, as well as loss of those opportunities. Especially in Texas, construction and new supply has been excessive, and there's been a lot of jobs surrounding that. That is not the case of what's in the supply chain now. It's good that we're absorbing more of these units, but there's not as many of those jobs available. We are obviously watching trends internally. We have a business intelligence dashboard that pulls in all of our renewal data, all of our leases to applications, closing ratios. So we are watching the KPIs. I think most management companies are tracking. It's just important that they're not siloed, because you could have high retention but not grow rents. You could have high leads into your funnel but not be closing applications, or have not the best resident or prospect experience. So I think that the key is ensuring you're watching things as a global view, and then adjusting and giving that feedback to your clients before these things become a problem. So we're first to try to build relationships with new businesses coming into the area, to offer discounts, to just be competitive and have an edge in building those relationships. But as job growth has slowed, or there's been migration out of the city, like we shared about ICE earlier, it's concerning. How will these deals restabilize? Where are the people going to come from is a looming concern over the region at this point.
Yes, yep. Makes sense. That was a question I was going to ask you. Um, as we were going through things, it'll come back to me. Um, one question. So I know each different investors focus on different assets. Some are heavily focused on high-rise condos instead of multifamily. And I just remembered the question I was going to ask you earlier. But as far as condos versus multifamily, do y'all ever go after condos, or is that kind of an asset class where you're like, it's just not in what we're looking for?
We're just multifamily at the moment, all apartments, but just depends on the ownership strategy, the hold period, what the business plan is. There's money to be made in all respects of real estate, but there are niches of how to manage that real estate. So we're not working with any HOAs currently, no single family homes. It's all multi. Our smallest property is 56 units, and our largest is 678 units. So it aggregates to about 250 units per property, but we are, open to managing smaller or larger as long as the business strategy makes sense for how we could operate it to an expense ratio that makes sense for the client.
Got it. Got it. And the question I had earlier was, what makes y'all's property unique versus another multifamily property for the tenants, as far as, if they're looking for a property, or maybe it's something you're moving towards, because I know you have some properties that you're, still transitioning. What are your thoughts around that?
Well, we are managing some very challenging assets. So I think just customer service, focus on improving the residents' experience when we come into these assets that have had no money for months. Management has not fixed things. It's a really challenging situation to walk into and try to retain that business while we're repositioning the property. I think communication and having resident experiences where you're bringing them in the office, you're talking about what you're changing. I think that is the name of the game, having the relationships being built, because people that lease apartments, they're picking a home. This is a emotional experience. It is where they come home and celebrate holidays, bring their baby home for the first time. I mean, this is definitely not transactional like you're staying somewhere for a night. So we take that very seriously and have a lot of empathy in our business and compassion to the circumstances that these residents are experiencing. And there's so much movement with AI, with people not talking to humans as much as what we had previously. And I feel strongly that this will always be a people business, that we will always need to build those relationships and to focus on that more than ever. And as an industry, I think we've gotten a bit away from that until things got hard. And now it's like, oh my gosh, we need to build the relationships. We need these people to feel confident here and to renew with us and to work through these challenges on our property. And so that is more of a lens from a distressed space, Gary. But I will say, no matter what type of properties that you manage, the bar needs to be raised. We need to have that experience even in a class A high rise. It's just that resident is going to have a higher level of expectation from their management than what someone is on one of my C class properties who hasn't had AC in 3 months, and we come and fix their AC. And, that's almost a guaranteed renewal for us living in a circumstance like that. So I really hope that as much as we embrace technology and where AI is taking us, that we always remember, this is an emotional experience for our residents, and it's important to keep the human touch in this business.
Love it. Yeah, that's so important, and I'm glad you touched on that, because I think sometimes when people think about improving an asset, they think about the bells and the whistles and that sort of stuff, for lack of better words. But the relationship piece, the human to human connection, I think is critical, and appreciate you sharing that. And of course, AI will always be there for data analysis and some operational things, but but yeah, you got to keep the connection there alive.
Mhm.
I know we're at the top of the hour here, short on time. Any last thoughts, for whether that be for investors or operators of these types of properties?
Just hang in there. We're in it together. This is a great opportunity to buy distressed real estate. If I can be a resource for you, Gary, or for anyone in your network to evaluate an asset, to give a perspective from a management lens and also from an investment lens, because I have straddled both in my experience. I'm happy to do that and to just stay vigilant. It's hard right now, but this will pass, and we'll be a lot stronger for making it through this cycle.
Awesome. Yeah, thank you for sharing that. And we mentioned relationships earlier. Um, And that's what this podcast is all about. It's all about relationships, connecting people. We're building an ecosystem to where people can help each other, people can learn from each other and grow together. So thank you so much for joining us today.
Yeah, thank you for the opportunity, Gary. It's wonderful chatting with you, and we have a lot more to discuss offline.
Absolutely. All right. Thanks, Amanda. And before we close out, we do want to give one final shout out to our sponsor, America's Smart Homes and Businesses. They're providing air conditioning service, repair, maintenance, and replacement for air conditioning systems, whether that be single family or multifamily. And their tagline is they find the problem before you feel the problem. So with their maintenance plans and analytics, they try to catch things early and not wait till a home is hot or cold and before it gets too expensive, as far as repairs go. Okay, thank you for our listeners for tuning in, and stay tuned for future episodes of the Beyond Wall Street podcast.